Two people buy a home in the same neighborhood in the same year at the same price. 20 years later, one of them is financially free, the other is broke. Not struggling, broke. And the house? The house is the reason. That right there is the paradox this video is about. Not the market, not bad luck, not a job loss. The asset they trusted most became what silently dismantled everything else. This is not about avoiding real estate or physical assets. It is about the psychological trap that forms the moment you acquire something significant. And how it quietly reshapes every financial decision you make after that. The core idea is not about assets. It is about identity. The moment an asset becomes part of how you see yourself, it stops being a tool and starts being a trap. We will call it the anchor identity loop. You acquire an asset. Over time, it merges with your identity. Now you no longer evaluate it with logic. You protect it emotionally. Selling feels like losing yourself. Questioning it feels like an attack. And that protection silently limits your wealth year after year without you ever noticing. The 3 layers of the trap. The anchor identity loop operates in 3 distinct layers. Understanding each one is critical because each layer reinforces the next, and skipping past any of them means missing the full picture. Layer 1, the emotional overvaluation problem. When something is yours, your brain assigns it a value that the market does not agree with. This is not a metaphor. It is a documented cognitive bias called the endowment effect. The moment you own something, you begin to perceive it as worth more than it actually is. Not slightly more. In some studies, people valued owned objects at 2 to 3 times what they would have paid to acquire them. Now apply this to a home or a business. You have lived in it, built memories in it, poured money and time into it. Your brain has accumulated a mountain of emotional evidence that says this thing is extraordinarily valuable. And when the market disagrees, when a buyer offers less, when a valuation comes in lower, when an advisor suggests it might be time to reconsider, your emotional valuation collides violently with reality. And most people choose their emotional valuation every time. This means they hold too long. They invest more into a declining asset to protect its perceived value. They pass up better opportunities because reallocating capital means admitting, on some level, that the original asset was not as strong as they believed. The emotional overvaluation does not just affect the asset. It affects every financial decision that touches the asset. Layer 2, the liquidity illusion. The second layer is more structural but equally dangerous. Most significant assets, homes, businesses, retirement accounts tied to property, are illiquid. You cannot access them quickly. And for long periods of time, this feels fine. In fact, it feels responsible. You're not spending the money, you're building wealth. But illiquidity creates a kind of financial blindness. Because the value is not in your bank account, because you cannot see it move, it registers in your mind as stable and secure. Meanwhile, your actual liquid financial flexibility, your ability to respond to opportunities, absorb unexpected costs, or pivot your strategy, is constrained, in some cases, severely constrained. Most people do not feel the cost of illiquidity until they need liquidity, and by then, the options are bad. A forced sale in a down market, a high-interest loan against the asset, tapping retirement funds early, the illusion of wealth, the number on paper, was never accessible when it mattered most. Layer 3, the maintenance tax. Nobody counts. The third layer is the one people are most surprised by when they actually calculate it. Every major asset carries what might be called a maintenance tax, the continuous, compounding cost of keeping the asset operational, presentable, and protected. For a home, this includes repairs, property taxes, insurance, utilities, renovations, upgrades, and the time cost of management. For a business, it includes staffing, overhead, compliance, technology, and the psychological cost of constant operational responsibility. For a car that has become an identity symbol, it includes payments, fuel, insurance, and maintenance that together exceed what simple transportation would cost. The maintenance tax is rarely factored into the original acquisition decision. People calculate the purchase price. Sometimes they calculate the potential appreciation. They rarely calculate the total resource drain of ownership over a decade or two. And when you run those numbers honestly, which we will do later in this script, the results are deeply uncomfortable. Micro examples, the pattern in everyday life. You know the person who buys a car that costs 40% of their monthly income payment and tells everyone it is an investment in their personal brand. They are not lying to you. They believe it. The asset has already been absorbed into their identity. Now every financial decision they make must accommodate it. You know the couple who took out a second mortgage to renovate a kitchen in a home they were planning to sell in 5 years. The renovation cost them $30,000. It added $12,000 in market value. They felt good about it the entire time because the house looked beautiful and the house was them. You know the business owner who keeps a failing location open 2 years past. The point when closing it would have saved the business, because the location was the first one, and closing. It feels like closing a chapter of who they are. You know the investor who holds a stock far past its peak because they were the person who discovered it early, who recommended it to friends and family, who built a minor social identity around being right about it. Selling means admitting they were wrong. And admitting they were wrong feels impossible when the investment is tied to how they present themselves. These are not unusual people. They are not financially illiterate. They are all of us at different points around different assets. The asset changes. The psychology is identical. Rules and principles. How to break the loop. There are specific rules that separate people who use assets from people who are used by them. None of these are abstract. All of them require deliberate practice because none of them are intuitive. Rule 1. Audit your identity attachment, not just your balance sheet. Once a year, every person should sit down and ask a simple, uncomfortable question about each major asset they hold. If I had never owned this, would I buy it today at its current cost of ownership? Not at the price you paid, not what you think it is worth. At the full, honest, ongoing cost of what it is taking from your resources and your flexibility right now. If the answer is no, if you would not acquire it fresh today, that is important information. It does not mean you must sell immediately, but it means you are holding it for emotional reasons, and emotional reasons are not a wealth-building strategy. Rule 2. Calculate the maintenance tax before, not after. Before acquiring any major asset, build out a 10-year maintenance cost projection. Include everything: insurance, taxes, upkeep, replacement cycles, opportunity cost of capital. The opportunity cost is the piece people almost always skip, meaning what would that capital have returned if it were deployed elsewhere? When you include opportunity cost, honestly, many assets that feel like investments reveal themselves to be expensive choices dressed in the language of wealth building. Rule 3. Separate your net worth from your self-worth. This sounds philosophical. It is actually deeply practical. When your financial decisions are being made by the part of your brain that is protecting your identity, you lose access to objective analysis. The goal is to create enough psychological distance between what you own and who you are that you can evaluate assets with the same emotional neutrality you would apply to someone else's balance sheet. This takes practice. It requires you to consciously categorize your assets as tools, things that either serve your financial objectives or do not. Rule 4. Build liquidity as a strategy, not a leftover. Most people treat liquid savings as what remains after everything else is covered. Sophisticated wealth management works in the opposite direction. Liquidity is allocated first, intentionally, as a strategic resource. The reason is simple. Opportunities do not schedule themselves around your cash flow. Crises do not either. The person with consistent liquidity can act when action matters. The person who is fully deployed into illiquid assets is always one emergency away from being forced to make decisions under pressure, and pressure destroys returns. Rule 5. Revalue your assets on a schedule, not on a feeling. Human beings naturally revalue their assets when prompted by positive external signals. When the neighbor's house sells for a high price, when the stock ticks up, when someone admires the business. What they almost never do is revalue assets during quiet periods, or when the signals are neutral or slightly negative. This creates a systematic upward bias in how people perceive their own net worth. Set a calendar reminder. Every 6 months, sit down and apply honest, market-based valuation to every major asset you hold. The number you arrive at may be uncomfortable. Discomfort is data. Rule 6. Never let a sunk cost govern a forward decision. The money you have already spent on an asset is gone. It is not coming back regardless of what you do next. The only question that matters is, given where this asset is right now, does continuing to hold or invest in it make sense going forward? If the answer is no, the fact that you have already spent a significant amount is completely irrelevant to the analysis. This is the sunk cost fallacy, and it is one of the most expensive cognitive errors in personal finance. It keeps people in homes they should have sold, businesses they should have closed, and careers they should have left, because leaving means acknowledging that the resources already invested did not produce what was expected. Rule 7. Understand the difference between an appreciating asset and an appreciating identity. Not all assets that go up in value are good investments. If the asset appreciates in value but continues to consume resources, taxes, maintenance, time, management, faster than the appreciation compounds, it is not building your wealth. It is redistributing it. An asset that appreciates your identity while consuming your financial flexibility is a particularly dangerous version of this. It feels like success, it signals success to others, and it silently drains the resources that actual financial independence requires. Rule 8. The asset you are most reluctant to discuss critically is usually the one that needs the most scrutiny. There is a reliable psychological heuristic here. The asset you get defensive about in conversation, the one you feel the need to justify or explain whenever it comes up, is the one that has become most entangled with your identity. Defense is not evidence of value. Defense is evidence of attachment. An attachment, when it governs financial decisions, consistently produces worse outcomes than rational analysis. Section 7. Numbers and reality check. Let us make this concrete, because abstraction is easy to dismiss. Assume someone purchases a home at $350,000. The mortgage, at current average rates, generates a monthly payment of around $2,100 over 30 years. Over those 30 years, the total payments, principal and interest, come to approximately $756,000 before a single dollar of maintenance. Now add the maintenance tax. Industry averages suggest that annual home maintenance costs between 1 and 2% of the home's value per year. On a $350,000 home, that is between $3,500 and $7,000 annually. Over 30 years, using the conservative figure, that is $105,000 in maintenance alone. Insurance, property. Taxes. These add another substantial layer. In many markets, property taxes alone can total between $60,000 and $100,000 over a 30-year ownership period. The total cost of owning that home, when calculated honestly, frequently exceeds $1 million. Now, the home appreciates. In a strong market, after 30 years, it may be worth $700,000. That sounds like a gain. But when you subtract the total cost of ownership, the true all-in number, the real return is far smaller than it appeared. And crucially, that return was entirely illiquid until the day you sell. You could not access it during the years when a liquidity event, a business opportunity, a market dip that was a buying opportunity, a family health crisis, required flexible capital. Now run the alternative scenario. The same individual, instead of concentrating their entire financial architecture around the home, maintains a portion of that capital in a diversified liquid position and invests modestly but consistently. Over 30 years, the compounding on even modest, consistent investment produces numbers that most people, genuinely, are not prepared to see when they run the calculation honestly for the first time. The math is not the villain here. The math is neutral. The villain is the assumption that the biggest asset is automatically the best asset, simply because it is the biggest. Future projection. Let us bring this to you directly. If you continue on the current path, the one where your biggest asset is also the organizing center of your financial identity, here is what the next 10 to 15 years will likely look like. Your net worth on paper will grow, probably. The number will feel good, but your financial flexibility will remain constrained. Opportunities that require liquid capital will pass you by because you are always a few steps away from being able to act. The maintenance tax will grow as the asset ages, and when a decision point arrives, a forced relocation, a market correction, a life transition, you will find that the wealth you believed you were accumulating was largely theoretical. The asset will require you to execute the financial life it demands, rather than the financial life you want. The decisions you make will not feel like compromises. They will feel like responsibilities. That is the sophistication of the trap. It does not feel like a trap. It feels like being a responsible adult. Now consider the alternative future. The same number of years, but spent operating with awareness of the anchor identity loop. Every major asset acquired with honest, full-cost accounting. Regular audits of identity attachment. Liquidity treated as a strategic priority, not a luxury. Maintenance tax calculated in advance and factored into decisions. Over 10 to 15 years, this approach produces something that cannot be measured on a balance sheet alone. It produces options. The freedom to choose work you actually want to do. The capacity to absorb disruption without panic. The ability to capitalize on opportunities that are invisible to people who are fully committed to servicing their assets. And perhaps, most importantly, it produces a financial psychology that gets stronger over time, rather than one that becomes increasingly rigid and defensive as the assets grow and the identity deepens. The two futures are not equally distant. The decisions that separate them are being made right now, in this period of your life, in the choices that seem small but compound invisibly over decades. The goal was never to own things. The goal was freedom. Somewhere along the way, millions of people confuse the two because assets are visible and freedom is not. The home, the car, the business, none of them are traps by nature. They become traps the moment they stop being tools and start being identity. The people who build real wealth are not people who own less. They are people who can look at what they own and ask, honestly, is this still serving me? Your biggest asset is not your problem. Your attachment to it is.